Hi everyone, welcome to FinTech Academy. This is Hirsch. Today I will be going over the Canadian income tax T2 topic about what is tax on split income, also referred to as TOSI, and how does it work. Yeah, a little bit challenging topic, but I'll try to make it easy and simple as far as possible by showing some examples. All right, let's get started with this. All right, so what is TOSI? Tax on split income is a set of tax rules that took effect on January 1st, 2018. The rules are designed to limit the benefit of income splitting through private corporations. Income splitting refers to the ability of a business owner to sprinkle bits of income to various members of his or her family, including children, brothers, sisters, and parents, so as to reduce that business owner's overall tax obligation. TOSI rules apply when the income recipient is an adult family member and has not made a sufficient contribution to the business. So I'm pretty sure you guys have already got a little bit gist of what this topic is going to be about, right? A very advanced topic, but wherever there is, put an example like a corporation and the business owner or would like to sprinkle or split the income, and how was it happening before and what were the benefits, and after TOSI came in, what has changed. And that's what I'm going to explain in this video tutorial with some numbers, so that you'll have a good understanding that why and what is this TOSI thing. All right, let's continue further. Right, so what does TOSI do? TOSI removes split income tax benefits by identifying some specific methods of income splitting that had previously reduced taxes and taxing that split income at the taxpayer's highest marginal rate. So to illustrate, as an example, if Joe earned $100,000 in dividend income from his corporation in Ontario, he would pay approximately $16,700 in tax in that year. Now, any numbers that I talk about over here is just an approximate amount that we're talking about for this current year. Mean to say, when we are in 2021, the rates are, of course, for 2020. This is just to give a rough idea and how this TOSI things works. None of these numbers are to be considered accurate or perfect, and to do any kind of tax planning on this basis. If you want to do tax planning, then you should definitely refer to a tax planner or a accountant or someone who is doing the tax practices. This is an educational video for understanding. Okay, so let's continue further. That if Joe earned $100,000, right, then he would pay approximately $16,700 in tax. However, if Joe distributed, or in bracket as sometimes the term is used, sprinkled $20,000 off the income to his son, $20,000 to his daughter, and $20,000 to his spouse, then Joe would only pay a tax on $40,000, while his family members paid tax on their respective $20,000. So basically, out of 100,000, what he says that, hey, I'm going to keep 40,000 for myself, and I'm going to just divide the 20,000 to each of my family members, who are three. So that's it. Total comes to 100,000. Well, very good plan. On the $40,000 that Joe took as dividend income, he would pay only a tax of $1,190, which is even better. Each of his children and spouse would only pay $180 in tax on their $20,000 income. Multiply this by 3, and the children/spouse would pay only $540 in tax combined. So 180 times 3, they're gonna walk out with a tax payment of $540. When adding all of the tax obligations of the family together, Joe only pays $1,730 approximately, so it's 1,190 for himself for the 40,000 and $180 for each of the $20,000, so that comes to that amount on his 100,000 of dividend income, instead of 16,700 if he hadn't used income sprinkling. So if he hadn't used this way of sprinkling the income, then straight away he would have paid $16,700. But hey, you know what? Someone advised him, and this can be done, and this is what is a good way, because thereby you will be saving a tax of 14,970 in tax in that 1 year. This is significant tax saving. We can see that, right? And this is exactly what got struck, that hey, you know what? This is a big amount of tax that has been saved. This was seen as a concern that business owners were able to shift their income to achieve these tax advantages. But yet these tools were not available for mere employees of the same corporation. And anyone would see that as a concern, that okay, well, if a business owner can put down the tax bill by whatever technique or whatever method, that seems to be a concern. And on the other end, if the employees are working, they are not able to get such kind of tools or benefits, and even though they are working for the same corporation. The employee had to pay a tax on the entire amount of his or her salary and was unable to shift the income or tax liability to his or her family members. For this reason, the proposal to eliminate the use of income sprinkling, where the family members do not contribute to or work for the family business. So what is important over here to understand is the income sprinkling where the family members do not contribute to or work for the family business. So it's not that you cannot do it at all, but especially where the family members are not doing anything at all and taking a cut out of it or taking a slice out of that amount, right? That's what the concern is, and that's what the concern was actually. And now that concern has been removed, right? Because the TOSI, which is tax on split income, has been incorporated. All right, so let's see what TOSI does now. All right, so how does TOSI work? What TOSI does is apply tax on split income at the highest marginal rate to the individual recipient, the family member. This virtually eliminates the entire advantage of income splitting, thereby curbing the use of this tax planning technique. It also causes the taxpayer to pay a higher tax than he would or she would have had he or she not attempted to income split. So let's understand with an example. To illustrate the effect of using the highest marginal rate on the income received using the example before, each of the three family members would be subject to the top marginal rate of 53.53%, meaning they would pay approximately $19,866.18 in the tax on their $60,000 of ineligible dividends. So we saw in this example that Joe distributed $20,000 to his son, to his daughter, and spouse. So each of them will be taxed at the highest now if they do that with this TOSI, and their combined tax, which was previously only like $540, will jump to $19,866 and approximately 18 cents for that $60,000 which they received. Joe himself would also pay $14,108.40 on his $40,000. So basically, that's what tax on split income would do. Not only it will be more tax they will have to pay, but they'll be punished because of using this technique of splitting the income. As a result, Joe would pay a total of $33,974.58 in tax on his $100,000. If Joe had not attempted to income split, he would pay only $16,700 in tax on that same $100,000 of ineligible dividends. Now, there are two types of dividends, of course, eligible and ineligible, right? That is a completely separate topic about the income tax T2, and a pretty detailed one as well. So I'm not going to go in that topic as of now, but for this example we will be focusing that it's an ineligible dividend, right? This punitive TOSI tax is meant to punish Joe for attempting to income split with his family members by requiring him to pay an additional $17,274.58 in tax in that year. So basically now it would not make sense to split income. Now, it doesn't mean that completely you cannot do or give payment to your family members at all. That's not what the goal is. There are exceptions and there are exclusions on that as well, wherein you can still continue if the family members are a part of the business. Right, so now that we know how does TOSI work, let's have a look at what are the exemptions where TOSI would not apply. So the ones which I'm going to go through, that's where the TOSI rules will not apply. So the first one, exclusion one, the excluded business exception for individuals aged 18 plus, so anyone who is 18 years and older. The excluded business exception will apply to any family member who is 18 years of age or older. To qualify for this exclusion, the family member must be engaged on a regular, continuous, and substantial basis in the business. This can be proven on a factual basis or by meeting a threshold of having worked on average at least 20 hours a week in the business in the current year. So basically, this is the first exclusion, that if they are working and if they are worked approximately that many hours a week, then TOSI rules would not apply in that case, and the individual should be 18 years and older. That's the first one. Number two, the excluded shares exemption for individuals aged 25 plus. An exclusion from TOSI applies for income or gains received on excluded shares held by individuals who are 25 years of age or older. Excluded shares means the shares represent at least 10% of the votes and the value of the corporation. So that's number two exclusion where the TOSI rules would not apply. Number three is the reasonable return test for individuals aged 25 plus. If the criteria for excluded business or excluded shares exception can't be met, there is another exception based on a reasonable return that can apply. It is limited to spouses and adult family members aged 25 or older. So if someone says I did not fall in the first and the second criteria for exclusion, well, there is one more. So what is it? Dividends can be paid to your spouse and not be subject to TOSI if the amount paid represents a reasonable return on their contribution to the business. Now, the important part over here is the reasonable return on the contribution of the business. In other words, the amount paid cannot be unreasonable when compared to your spouse's overall contribution to the business. That makes a very important part, and that's where something can be done with overall contribution of an individual or the family member or the spouse, what it is in the business. A little bit gray area, but yes, that is the number three exclusion. Exclusion number four, which is taxpayers with spouses aged 65 or older. The rules for this exclusion is simple. The TOSI rules will not apply on income received by the spouse if the spouse is at least 65 years old in that particular year. This exemption allows a business owner aged 65 or older to income split with his or her spouse without having to worry about the punitive tax on split income rules. So basically, these are the four exclusions as of now. Remember, guys, things keep on changing, right? So if you're going to take any of your tax decisions, it's always advisable to be updated what is going on with the industry, what are the updates from CRA, and advisable as well to consult or to read about and find out that what is it that can affect your corporation or your business. In this video tutorial, I'm going to summarize over here with the theoretical part, but I'm going to make another video tutorial where I'm going to show exactly, like, how the numbers go in the software and how there could be a change in the TOSI part. I mean to say, without TOSI, how much tax we are paying, and after the TOSI gets applied, what is the difference. So that will be in the part two, which I'll be making sometime later. But for this video tutorial, this is what is in the topic. Hopefully you have been able to understand and get the gist of what is TOSI. All right, guys, if you found this video helpful, please like our video and subscribe to our channel for more videos. Also, let me know in comments what would you like to see in future videos, i.e. Harsh, I want to see this video, or Harsh, can you make a video on this topic for accounting and bookkeeping, QuickBooks Desktop, QuickBooks Online, Microsoft Excel, Canadian Income Tax T1, Canadian Income Tax T2, or Canadian Payroll. Alternatively, you can also visit us at fintechsolutions.ca for our courses. Thanks for watching.